let me ask you something. Have you ever been stopped out of a trade by some crazy spike, only to watch the market immediately turn around and head exactly where you thought it would go? It's beyond frustrating, right? Well, in this explainer, we're going to dig into the idea that those moves, they aren't random at all. We're going to pull back the curtain and look at the market's hidden engine. Let's get into it. You know, this is the big question, isn't it? You stare at a chart, you see a sudden, vicious wick that just spears your stop loss, and it feels like total chaos. But is it really random, or is there some kind of hidden logic at play that maybe we just haven't been taught to see? And let's be honest, this quote nails it. This is exactly what trading feels like a lot of the time. Just pure chaos. The market seems to do things that are totally unpredictable, sometimes even irrational. If you've ever felt that way, trust me, you are not alone. It's a completely normal reaction to what we see on the charts every single day. Okay, but here's where things get really interesting. What if that feeling of chaos isn't the whole story? What if it's just a complex, purposeful process that we just don't know how to read yet? What if all that chaos we think we're seeing is actually just an illusion, and it's masking a system that's deeply logical? And that brings us to the key that unlocks this whole new way of looking at things: the Interbank Price Delivery Algorithm, or IPDA for short. The best way to think about the IPDA is like the market's secret operating system. It's the hidden engine, the institutional level program that is literally engineering price from one level to the next.
So, what we're really talking about here is a total shift in perspective. On the left, you've got the common perception, a market that's random, chaotic, driven by news. But on the right, that's the IPDA reality, a market that is algorithmic, driven by a relentless hunt for liquidity, and is, believe it or not, purposeful.
Okay, so that's the next logical question, right? If price isn't random, if it's being guided by a purposeful algorithm, then what's its mission? What is the IPDA actually trying to do? Well, it turns out it has two very specific targets it's always looking for. So target number one is what we call market inefficiency. Just picture this: some big news hits, and price just explodes in one direction. It moves so fast that it leaves behind a huge gap on the chart, a sort of void. To the algorithm, that gap is unfinished business. It's an imbalance that it is programmed to eventually come back to and fill. And then there's target number two. And honestly, this is the big one: the liquidity pool. These are just concentrated pockets of buy and sell orders. Think about all the stop-loss orders that build up just above a recent high or just below a recent low. For the IPDA, that's not just a bunch of orders, that's fuel. It needs to tap into those pools to get the big institutional orders filled.
So here's the bottom line. The algorithm really only has two main jobs. It's two prime directives. First, and most importantly, it aggressively seeks out and captures liquidity. Then, as a secondary job, it works to balance out those market inefficiencies that it often creates while it's hunting for that liquidity.
Now, these two jobs don't just happen in a vacuum. They feed each other. They create this perpetual engine, a constant cycle of creating an imbalance and then rebalancing it. This isn't a one-time thing. It's the very rhythm of the market, happening over and over again on every single time frame. Let's break down that cycle. It all starts with phase one. An imbalance gets created. You'll see a sharp, aggressive move, often targeting one of those liquidity pools that pushes price super fast in one direction. And that action is what leaves behind that visible void on the chart we talked about. And that immediately kicks off phase two. The algorithm now wants to rebalance the books. After it's grabbed the liquidity it was after, its secondary mission kicks in. Price is deliberately, almost magnetically, drawn back towards that area of imbalance. This isn't price just randomly drifting back. It's a programmed maneuver. Finally, we get to phase three. The price delivery is complete. The algorithm successfully navigates price right back to that messy, inefficient area, filling the void. At that point, the market is considered balanced and efficient again, ready for the whole cycle to start all over. And this right here, this brings us to what might be the biggest takeaway from all of this. We're all taught that price is discovered through the push and pull of buyers and sellers. But what if that's not how it works at all? What if price isn't found? What if it's engineered? What if it is deliberately delivered with a purpose? So let's just recap this new reality. How do the banks actually deliver price? 1. It's a deliberate, engineered process. It's not random. 2. Its primary goal, its number one mission, is always to seek out liquidity. 3. Its secondary goal is to correct the imbalances it creates along the way. And 4, and this is the most critical part for you as a trader, Underneath all the noise and perceived chaos, there is a simple, repeatable logic. So I'll leave you with this final thought to really chew on. If the market is not just some random battleground, but is in fact a script, a program being methodically executed day in and day out, how does that fundamentally change the way you read it? How does that transform your entire approach to trading?